I am Justin Lancy Banyes, and I'm going to discuss about what is the money market and how it works. So here in our lecture, chapter 4, the term money market refers to the network of corporations, financial institutions, investors, and governments which deal with the flow of short-term capital. So what does a short-term capital mean? A short-term capital are gains that are gained from assets that are held within a year or less than a year that were sold. So these short-term capital gains are taxed as regular income. Unlikely, the favorable one is the long-term capital, which is they are taxed from graduated thresholds. They are specific tax numbers. So in the money market, it involves in the sale and purchase of large volumes of short-term debt products such as overnight reserves and commercial paper. So money markets they exist because they enable the banks, the governments, and other large institutions to raise money by selling their short-term securities to investors. Also, it allows investors like individuals and also other large institutions to invest their excess money at a very low risk. So how does this money market work? So let's start in the large corporations. Large corporations, when they need cash flow, they can borrow money by selling securities, or corporations that has excess money can be the investors. So next is the small companies. They can invest through mutual funds or they can invest through their bank. Also, investors can invest through their money market mutual fund or their money market bank. So what are the types of securities that the investors can issue or invest in the money market? So the first one is the government issued treasury bills. These treasury bills have maturities of 1, 3, 6, and 12 months. The next one is the certificate of deposit. This is issued by the commercial bank, which has a maturity of 3 months to 5 years. Next is the commercial paper. These are unsecured loans from corporations that are need to fund the short-term cash flow needs. And next is the short-term mortgage-backed securities. So these are investments secured by a mortgage. So next is the banker's acceptance. So this is issued by a non-institutional corporation but guaranteed by a commercial bank. So next is the banker's acceptance. So this is issued by a non-financial institution but guaranteed by a commercial bank. Next is repurchase agreements. So it is a short-term form of borrowing that involves selling a security with an agreement that you will repurchase it at a higher price. So those are the types of securities that the investors can issue or invest.
Good day everyone, I am Mark D. Nino Franco and I will going to report who uses the money market. So primary function of money market is for banks and other investors with liquid assets to gain a return on their cash or loans. So bank and other investors who has an unneeded cash provides short-term funding to the other banks, brokerage, and other borrower, and at the same time having a gain or return with their investment within a year. So the money market is dominated by professional investors, although retail investors can also invest. Even though the monetary market is dominated by professional investors, smaller or retail investors with 50,000 cash, more or less, can also invest, and the smaller deposits can be invested via money market fund. So, companies. When companies need to raise money to cover their payroll or running costs, one example of payroll and running costs is salaries and monthly bills. They may issue commercial papers. So, commercial papers is short-term unsecured loans for 100,000 pesos or more that mature within 1 to 9 months. So, banks. If the demand for long-term loans and mortgage is not covered by deposits from saving accounts, bank may then issue certificate of deposit with a set interest rate and fixed term maturity up to 5 years. Investors. Individuals seeking to invest large sum of money at relatively low risk may invest in financial instruments. Sum of less than 50,000 pesos can be invested in money market funds. So the center of each web is the central bank whose policies determine the short-term interest rates. So we all know that central bank plays a vital role in every country's economy. It keeps maintaining the market competitive by setting a fair and reasonable policies for both a lender and a borrowers. So next is what money market do. So first of all, what is the meaning of money market? So there is no precise definition of money market, but the phrase is usually applied to buying and selling of debt instruments maturing in 1 year or less. So money market investors are extending credit without taking any ownership in borrowing entity, just similar to bond investors. But money market and bond market serves in different purpose. Bond issuer typically raise money to finance investment that will generate profits, while money market instrument issuer usually more concerned with cash management. A well-functioning money market facilitates the development of a market for long-term securities. So, if money market are active or liquid, borrower and investors have the option of engaging in a series of short-term transactions rather than in long-term transactions, and it tends to result in downshift of long-term rates. And that's end my report, and thank you for listening.
Good morning, ma'am. Good morning, classmates. I'm J.N. Columbres. I was assigned to discuss the types of money markets instruments. So first, what is money market securities? It is a short-term instrument with an original maturity of less than 1 year, so it is outstanding only for the short period of time. Money market are used to warehouse funds until needed, and the returns earned on these investments are low because of low risk and high liquidity. Money market securities are usually more widely traded than longer-term securities, and so tend to be more liquid. It's because money market securities was invented to provide greater liquidity for the companies and to keep them liquid on day-to-day basis. So that's why most companies, they prefer short-term securities over long-term securities. So the first type of money markets instruments is commercial paper. Commercial paper is a short-term debt obligation of a private sector firm or a government-sponsored corporation. So only companies with good credit rating commercial paper. Issue commercial paper because investors are reluctant to bring death of financially compromised companies. In most cases, the paper has maturity which greater than 90 days but less than 9 months. So this maturity was dictated by regulations. Here in our country, which is the Philippines, most new securities must be registered with the regulator, which the Securities and Exchange Commission. They tend to be issued by highly rated banks. Commercial paper is actually unsecured but can be secured if guaranteed by a bank or secured by a specific asset of the issuer. So many large companies have continual commercial paper programs because it allows issuers to borrow money for a long period of time and with a short-term interest rates, and in the part of investor it is low risk because of short maturity. These continual borrowing programs are not riskless. It is not riskless if market conditions or a change in the firm's financial circumstances preclude a new commercial paper issue and its lack of the cash to redeem the paper that is maturing. So the issuer will face the defaults. Next, the banker's acceptance. Before 1980s, bankers' acceptance were the main way for firms to raise short-term funds in the money markets. An acceptance is a promissory note issued by a non-financial firm to a bank in return for a loan. So for the first that issues banker's acceptance, it is a way to pay for a purchase without borrowing. For the first that receives it, the bill is guaranteed for as a form of payment. They do not bear interest. Instead, an investor purchases the acceptance at a discount from face value with a usually maturity of less than 6 months or 180 days. So it is a short-term debt instrument that is traded at a discount to face value in the money market. Investors rely on the strength of the guarantor bank rather than of the issuing company for the security. It's because they rely on the creditworthiness of the banking institutions rather than individual or businesses issuing it. Is bankers' acceptance are considered to be safe form of investments? Yes, because bank requires the issuers meets its credit eligibility requirements. Next is treasury bills, or also known as T-bills. It is securities with maturity of 1 year or less issued by national governments. So when you buy one of the securities, then you are essentially lending money to a government. And treasury bills issued by a government in its own currency are generally considered as the safest of all possible investments in the currency. It's because they are backed up by the US government. Treasury bills are also a highly liquid form of investments. This means that they are easily tradable. They can be sold on the secondary market and easily converted into cash. So since the treasury bills is so low risk, then the downside of this that the returns are smaller than the other form of investments. Next is government agency notes. National government agencies and government-sponsored corporations are heavy borrowers in the money markets in many countries. So they do not lend money to public directly. Instead, they guarantee third-party loans and purchase loan in the secondary market to ensure the liquidity. So this includes entities such as development banks, housing finance corporations, education lending agencies, and agricultural finance agencies.
Good morning everyone, my name is Celine T. Tambagahan. I will be discussing the additional money market instruments. Money market instruments provides funds, helps us use of our surplus funds, no need to borrow from bank, it helps government, it helps us in financial mobility, and promotes liquidity and safety. Local government notes is a money market instruments. These are government paper or debt securities issued and guaranteed by provincial or local governments and by agencies such as schools authorities and transport commission. In issuing this government paper varies in every country. In other countries, they need an approval by their national authorities, while in some local agencies, they are only allowed to borrow from the bank. In addition, the issuance of the government paper of a nation is usually perceived as the least risky class of debt securities and will offer investors the lowest yields compared with debt securities of similar maturity issued by other entities. Example of government paper. U.S. government paper, especially viewed as a kind of international standard for a risk-free rate of interest. As a dominant world geopolitical and financial power and the issuer of the most popular world reserve currency, the U.S. government paper is considered to be among safest investment and practically risk-free. Next, money market instrument, interbank loans. Loans are extended from one bank to another without affiliation. When we say interbank loans as overnight loans, it is repaid interest in a state period of time, often within a day. The purpose is that to ensure that banks meet their capital requirements at the end of each day. For example, the regulatory agency have set the requirement for liquidity of assets. Bank A, who has a shortage of liquid assets, can borrow from Bank B, who has an excess of liquid assets, in order for Bank A to meet their capital requirements. Next, time deposits. Deposit locked in a set amount of time, also referred to passive income. Two terms of placement or the length of time wherein the deposit will remain in the bank, time deposit which lasts for as long as 5 years, time deposit which terms as brief as 30 days. We have this term in time deposit which we called as locked-in period, also known as terms of placement, maturity, or tenor. These are length of time that deposit remains in the bank. Depending on the bank you choose, the initial deposit or the minimum placement can be as low as 1,000 and as high as 50,000. You can also choose your locked-in period. So most financial institutions set a minimum locked-in period of 30 days and a maximum of 5 years and 1 day. You can also opt for 60, 90, or 180, or even 1 day or longer. Advantage is that when you have higher initial deposit and longer lock-in period, the higher the returns on the deposit. The disadvantage, should an emergency arises and you need to withdraw your deposit, fees will be charged when you pre-terminate the time deposit. This happens when you withdraw your deposit beyond the maturity date. So there are some consideration before opening time deposit account. First is the interest rates. So there are banks here in the Philippines with high interest rates of time deposit account, such as Security Bank, PBCom, East West Bank, RCBC, Maybank, or Maybank Philippines, BPI Direct, China Bank, Metro Bank, Union Bank, UCPB, and BDO. So if you want to open an account for time deposit, those are banks with high interest rates. Second, consider the minimum deposit required to earn interest, fees and charges, as well as the maturity date. In addition, compared to savings account, time deposit have relatively higher interest rates and are considered virtually free risk investments. Last, repurchase agreement or repos, also known as reverse repo. These are loans of short duration which requires collateral and are agreed by buyers and sellers for the purpose of selling and repurchase. For example, trader A may sell specific security to trader B for a set price and agree to buy back the security for a specified amount at a later date. In this case, B would like to guarantee that trader A will buy back the security. What he does is that B asks for a collateral from A. In repos transactions, can only be permitted between securities approved by RBI such as the central or state government securities, treasury bills, and PSU bonds. Pros: secured loan, safe investment because there's underlying collateral. If the borrower default to repay, the lender can sell the security. Easy liquidity for the borrower. Cons: subject to counterparty risk. If the counterparty becomes bankrupt or insolvent, the lender may suffer loss of principal interest, or in case of a counterparty default, the loss is uncertain. And that ends my report. Thank you for watching and listening. Keep safe, everyone.
For today's topic is about capital markets. Capital markets are one of the most fascinating areas in investing funding or investing banking. And it is financial markets in which longer term debt or original maturity of 1 year or greater and equity instruments are traded. Capital markets are funding infrastructure for the economy. It is the place where the securities exchange between the two parties. And when we say the securities, these are the capital market securities that include bonds, stocks, and mortgages. It is often held by financial intermediaries such as insurance companies and pension funds, which have little uncertainty about the amount of funds they will have available in the future. It means it helps to channelize surplus funds from savers to investors, which then invest them into productive use. Capital market participants. Who are the primary issuers of capital market securities? These are: number 1, the national and local government. And number 2, the corporations. The national government issues long-term notes and bonds to fund the national debt. It only focuses to the national, while the local governments issue notes and bonds to finance the capital projects. And The second one is the corporations. Corporations issue both bonds and stocks to finance capital investment expenditures and fund other investment opportunities. Corporations may enter the capital market because they do not have sufficient capital to fund their investment opportunities. Next is the capital market trade, which consists of primary market and the secondary market. Let's proceed to primary market. Primary market is where the new issues of stocks and bonds are introduced. Again, new issues of stocks and bonds. The primary market is where securities are sold directly from the issuer to investors. Investment funds, corporations, and individual investors can all purchase securities offered in the primary market. Generally, institutions like investment funds, pension funds, mutual funds, insurance companies, and so on are the only players in the primary market. Usually, individual investors don't get to participate in the primary market. Primary market transaction is one where the issuer of the security actually receives the proceeds of the sale. When firms sell securities for the security, actually receives the proceeds of the sale. When firms sell securities for the first time, the issue is an initial public offering or the IPO. Like for example, the company is the issuer. The primary market is with securities like stocks and bonds first become available. This initial sale is often called an initial public offering or the IPO for short. Subsequent sales of a firm's new stocks or bonds to the public are simply primary market transactions. Next, the secondary market. The secondary market, on the other hand, which you may often hear called the stock. It is where the sale of previously issued securities takes place, and it is important because most investors plan to sell long-term bonds before they reach maturity and eventually to sell their holdings of stocks as well. The secondary market has many individuals in participating in it when stocks and bonds are sold. The issuer receives no additional capital like they do in the primary market. In fact, the key distinction between the two markets is that in the primary market, the issuer sells securities and they receive the capital. And in the secondary market, securities are bought and sold to and from other investors. So if an investor buys shares of a company through secondary market, they are buying those shares from another investors. Therefore, it is ultimately supply and demand for individual shares that drive the price of any one security. Well, if there are more buyers relative to sellers, while the price of the security will move higher, and the opposite is true. There are more sellers than buyers, the price would fall. That is the basics of how the stock market is set up. And the key differences between the primary and the secondary markets. There are two types of exchanges in the secondary market for the capital securities. One is the organized exchanges and the other is over-the-counter exchanges. Whereas most money market transactions originate over the phone, most capital market transactions measured by volume occur in organized exchanges. An organized exchange has a building where securities, including stocks, bonds, and options and futures, trade. So this will be the end of my report. Thank you for listening.
Good morning, everyone. I am Giselle Razonable. Today, I will discuss about the bonds. When we say bonds, it is any long-term promissory note issued by the firm. A bond certificate is the tangible evidence of debt issued by a corporation or governmental body and represent a loan made by investors to the issuer. Bonds are the most prevalent example of the interest-only loan with investors receiving exactly the same two sets of cash flow. The first, the periodic interest payment, and the second, the principal or par value or face value returned at maturity. Trading process for corporate bonds. The initial or primary sale of corporate bonds issues occurs either through a public offering, using an investment bank serving as underwriter, or through a private placement to a small group of investors, often financial institutions. Generally, when a firm issues bonds to the public, many investment banks are interested in underwriting the bonds. The bonds can generally be sold in a national market. Most often, corporate bonds are offered publicly through investment banking firms as underwriters. Normally, the investment bank facilitates this transaction using firm commitment underwriting as illustrated in Figure 1. The investment bank guarantees the firm a price for a newly issued bonds by buying the whole issue at a fixed price or the bid price from the bond issuing firm at a discount from par. The investment bank then seeks to resell the security to the investors at a higher price or the offer price. The investment bank takes a risk that it may not be able to resell the securities to investors at a higher price. This may occur if a firm bond's value suddenly falls due to an unexpected change in interest rates or negative information being released about the issuing firm. If this occurs, the investment bank takes a loss on its security underwriter team. However, the bond's issuer is protected by being able to sell the whole issue. Thank you.
My name is Casey May Bernardino Mateo, and I'm going to discuss about advantages and disadvantages of using bonds. Advantages of bonds. Number 1. Long-term debt is generally less expensive than other forms of financing because, letter A, investors view debt as a relatively safe investment alternative and demand a lower rate of return. When we say long-term debt, is debt with maturities greater than 12 months. Letter B. Interest expenses are tax deductible. What if tax deductibility of interest expenses were eliminated? So these are the possible outcome if interest expense were or tax deductibility of interest expenses were eliminated. the shareholder value would be decreased by 3.5%. Firms would be smaller and less levered, would be less productive capital. Number 2, bondholders do not participate in extraordinary profits. The payments are only limited to interest. When we say bondholders, they are or is an investor or the owner of debt securities that are typically issued by the corporation. They are the one who lends money to the bond issuers. Number 3, bondholders do not have voting rights. It's because bonds do not offer ownership participation in a company through a return of profits or voting rights. Again, it's because bonds do not offer ownership participation in a company through a voting rights. Instead, they represent the issuer's loan obligations and the likelihood of repayment and other factors influencing the price or influence their pricing. Let's proceed to advantage number 4 is flotation costs of bonds are generally lower than those of common equity shares. When we say flotation costs, these are incurred by a publicly traded company when it issues new securities and incurs expenses. So that's why flotation costs of bonds are generally lower compared to other ordinary equity shares. Next, let's proceed to disadvantages of bonds. Number 1, debt or other than income bonds results in interest payments that, if not met, can force the firm into bankruptcy. This is because bond issuers agreed to pay investors interest on bonds through the life of the bond and to repay the face value of bonds upon maturity. Let's proceed to number 2. Debt produces fixed charges, increasing the firm's financial leverage. Although this may not be a disadvantage to all firms, it certainly is for some firms with unstable earning streams. Leverage can also refer to the amount of debt a firm uses to finance assets. If a firm is described as highly leveraged, the firm has more debt than equity. But as we all know, too much debt can increase the risk of default or bankruptcy. Number 3, debt must be repaid at maturity and thus at some point involves a major cash outflow. So as what I've said, number 1, bond issuers agree to pay investors interest on bonds through the life of the bond and to repay the face value of bonds upon maturity. Now let's proceed to number 4. The typically restrictive nature of indenture covenants may limit the firm's future financial flexibility. A bond's indenture is the portion that contains the covenants, both positive and negative, and is enforceable throughout the maturity of bonds. That's all. Thank you.
Good morning, everyone. I'm Alisa Ashley Elrubalde. My topic is about bonds features and prices. Par value. The face value of the bond that is returned to the bondholder at maturity. For instance, a company might issue 1,000 peso 15-year bond to the public. The par value of these bonds is 1,000 peso. In other words, the company promises to pay the public back 1,000 peso 15-year from the bond issuance. Coupon interest rate. The percentage of the par value of the bond that will be paid out annually in the form of interest. To get the coupon interest rate, the formula would be stated interest payment divided by par value times 100. Suppose a bond has a par value of 1,000 peso and annual interest payment of 50 peso. Divide the annual interest payment, which is 50 peso, by the par value of 1,000 peso. Then, multiply by 100 to state the coupon interest rate as 5%. Maturity. The length of time until the bond issuer returns the par value to the bondholder and terminates the bond. Bonds often are referred to as being short, medium, or long term. Generally, a bond that matures 1 to 3 years is referred to as short-term bond. Medium or intermediate term bonds generally are those that mature in 4 to 10 years. And the long-term bonds are those with maturities greater than 10 years. Indenture. The agreement between the firm issuing the bonds and the bond trustee who represents the bondholders. It also provides the specific term of the loan agreement, including the description of bonds, the rights of the bondholders, the rights of the issuing firm, and the responsibilities of the trustees. Current yield. This refers to the ratio of the annual interest payment to the bond's market price. Suppose a bond has a market price of 4,000 peso and annual interest payment, which is 300 peso. Divide the 300 by 4,000 market price, then multiply by 100 to state the current yield as 7.5%. Yield to maturity. This refers to the bond's internal rate of return. This is the formula to get the approximate yield. The price of the bond is 900 peso with a par value of 1,000 peso. Assume that the annual interest payment is 100 peso, which is a 10% interest rate, and that there are 10 years remaining until maturity. This example using approximate formula would be the principal payment, which is 1,000 minus the price of the bond, which is 900, equals to 100 divided by the number of years to maturity, which is 10 years, equals to 10, plus the annual interest payment, which is 100, equals to 110. Now at the lower part, 0.6 times price of the bond, which is 900, equals 540, and 0.4 times principal payment, which is 1,000, equals 400. plus 400 plus 540 equals to 940. After solving this equation, the estimated yield to maturity is 11.70%. That's all. Thank you.